Hello and welcome to this conversation on markets and investments. We have with us here Shankarraman, and I'm going to get straight into the topic of the times. And as I speak, we are today we're recording this on 15th of May, and it's important to kind of give this date simply because if we were doing this probably say 6 days ago, I think the tone of this conversation could have been different. But now that we're here and we're seeing equity markets, in fact, as we speak today, I think equity markets globally, especially in emerging markets, seem to have gone through a little bit of a meltdown. But having said that, the point I wanted to begin this conversation was with this. Last 9-12 months, I think we've seen it all. We've seen the trade war, we've seen the AI scare, especially to Indian IT. We're seeing this whole Middle East crisis, the energy price shock, everything, and now probably we're going to see the El Niño as well. Let's keep Indian markets away for now. Equity markets globally are also seeming to react very differently now, unlike they reacted to until April. I think April, was a great month for global equities. So what has actually shifted in these probably last 2 weeks?
Yeah, it's interesting. I think before we get down to the here and now, just zoom out a little bit. April took everyone by surprise.
Absolutely.
I mean, no one could have expected such a massive everything rally, right? Where global markets rallied together. Even while the war was unresolved, and nobody has a clue as to when the war is actually going to end. Ceasefires are just that. The end is still very elusive. So I think the way I probably want to view it is there are probably two sides to this story. While energy supply chain is constrained and severely, I think the markets are at least temporarily taking comfort from the fact that, or hope, let us say, that this will end soon. A. B is, I think, the fact that before the conflict started, if you recollect, going back into late 2025, crude prices were expected to come down, and quite sharply. We were at about $70 to the barrel, I think, and expectations were that this year we would probably be between 55 and 60, which meant that the markets were saying that the crude market is hugely oversupplied. So I think we entered into the conflict with a hugely oversupplied kind of a market, which means there was enough amount of oil that was available, and the world was drawing upon them, and therefore the pain of the physical supply constraint had not hit. So I think that is an important element, and even as we speak, I think the drawing down of reserves is still underway. So that's number one. Number two, I think, is the fact that while there is concern around the conflict and crude prices have gone up by 50-60%, and if you look at natural gas or fertilizers are up by 80-90%, so on and so forth, I think corporate results have taken everyone by surprise. I think to see that the S&P 500,
imagine.
Yes, in a way. But to see that the S&P 500 has delivered a 28% earnings growth, I think that's the number that was there in the first quarter of 2026. I think it was and from what one gathers, I think the surprise, the percentage of surprise on broker estimates is at a multi-year high. So I think corporate results, provided that comfort to the markets. That was the second factor to my mind. And third is, of course, the fact that the world is awash with liquidity, and there is enough sign of that. Recollect that before the crisis happened in early March, late Feb, early March, you had this massive gold rally that happened somewhere in Jan. And you could see that liquidity is awash in the world. So therefore, I think all of these factors really contributed to what happened in April. Come to now, I think we are seeing data points actually start emerge, right? Where one is actually seeing inflation numbers go up. US inflation numbers in the last 4-5 days itself has seen a very, very sharp rise. You're seeing US producer price inflation at 6%. You're seeing consumer prices having gone up by 3.8%. And therefore, that's not setting a very great picture now, right?
Yeah, so that brings me, if I were to summarize your earlier point, you're basically saying that global growth was looking reasonably okay into the war, and it was okay, and now you're seeing inflation kind of go up. What does that mean for rates then? From that perspective, it's not sounding very positive for rates if I were to put 2 and 2 together.
True. I think, the fact that while bond yields went up in the aftermath of the conflict, starting in March, I think somewhere that while there was nervousness, I think the markets were still not coming to grips with the kind of inflation that could actually, emerge. We are seeing the first signs of that, where inflation is really kind of showing through, and even in India,
Exactly.
we'll come to that. But even in India, you're seeing signs of that, right? So I think that's where the market is showing the initial signs of nervousness. Now, if you look at therefore what bond markets seem to be suggesting, in the US, for instance, the next rate action is expected to be a rate hike. And there is an 80% probability that the markets is attaching to that kind of an outcome. So I think you're seeing a sharp, swift change in the mood of the markets. Now, the other dynamic that was playing out was the change in the Fed, dispensation, so to say, where the new dispensation was supposed to be a lot more benevolent.
You're referring to the new governor who's
yes,
okay.
Yes. So I think if inflation were really to be the way it is turning out to be, it's going to be very difficult for anyone to kind of push for a rate cut. And note that in the last Fed meet, you had the highest amount of dissidence within the Fed since 1992. So I think it's a little tricky, and therefore I think markets are beginning to come to grips with that the inflation picture is not going to be very pretty, and therefore you are seeing even gold react. In the recent days, you've seen gold actually come off.
In fact, I'm going to kind of step aside to kind of make that point. It's been different this time, right? There's been a war, gold prices corrected, treasury yields moved. It's a very different dynamic than we've seen in wars in the past. You want to kind of share your observation on that?
You said this time is different. And,
okay, I mean, in previous...
You and I know that those are the 4 most dangerous words in financial markets.
Yes,
so no, but yeah, jokes apart, I think the point that you're making is the market response to a
because normally
conflict.
Investors would have expected gold prices to kind of zoom up.
Yes.
If there was a war.
Yes.
I think it's been very different this time.
Yes. No, true. I think the traditional correlation that you see across asset classes is really not working, right? I mean, in the last couple of years itself, we have seen that.
And I'm going to hold on to this point on correlation, because you're going to use it. I'm going to come back to you on this when we talk about portfolios.
Yes. So I think that's really the backdrop in terms of how, therefore, you are seeing this whole rush towards AI, build out and the whole supply chain and what's happening, and therefore how parts of Asia is benefiting from that, and therefore how earnings are expected to virtually double in certain markets. So yeah, I think that's been the backdrop, but somewhere it looks like we are at the cusp of a turn. At least in the last few days, after the data point in the US inflation came through, it looks like we are on the cusp of something.
So let me pick up this entire model that you spoke about, growth, inflation, you spoke about it globally. If I were to superimpose it exactly onto India, we talk about growth in India, we talk about inflation in India. I think before I kind of toss up this question, there was this GST change that happened in August. A lot of people had very mixed opinions about it, but coming into post-festive demand, Jan, Feb, I dare say even March numbers for say auto sales, all of them looked quite good. So we entered this looking quite good. But now things seem to be turning a little soft. So how are you kind of assessing, I put it two ways, near-term growth and slightly longer-term growth? Because I'd like to understand how you're viewing earnings also from the same angle.
No, I think for India, interestingly, before February, you had a situation where the macros were looking good, right? You had current account deficit for FY26 at 0.8% roughly. The fiscal deficit was well within control. You had forex reserves which were more than 11 months of your imports. I think things were kind of okay. The macros therefore were kind of okay. It was really the micros where there has been some bit of a concern since I think middle of 2024, which is when the earnings cycle turned down for India.
So when you're saying micros, you're referring to earnings being
corporate earnings.
Corporate earnings being.
Yeah. So since then you've seen a little bit of a turn down in the earnings cycle.
Absolutely.
And I think you are beginning to see the first signs of a green shoot somewhere in October, November, when corporate earnings numbers actually started showing signs of improvement. Correct. And tangible signs of improvement, with top line revenue finally growing by double digits year on year, and profit growth also backing that up. So I think the stage was set for improving earnings growth, right? And therefore, from our own portfolio strategy standpoint, you'd know that we turned a little more constructive on equities somewhere in November.
Imagine November, yeah.
So yeah, that was really the backdrop. I think now, given where we are right now, the macro story has got a little kind of disturbed. I think we are seeing now a situation where the balance of payments is really become one very important
concern,
flashpoint,
yes.
So to say. And you're seeing the ripple effect of that on the currency.
On the rupee.
I think the rupee started showing signs of nervousness way back in October. I think somewhere in middle of October is when the rupee actually broke that 88, 89 kind of a range and started getting into the 90s. And that was largely because of FPI outflows and earnings and stuff like that. But now I think with this whole India's oil import dependence and stuff like that. So I think that is really what is causing the next round of nervousness in the rupee, which is obviously having its own impact on imported inflation and so on and so forth. If you just look at the results for March 26 and we're just concluding the results season, and data seems to suggest, like you said, the data is quite good.
So that seems to have turned, right? You started with strong macros, slightly weak micros. Now we are in a situation where micros are looking good, probably looking better.
Yeah.
But macros seem to have taken a temporary hit, I would say.
Yeah.
And hopefully, so therefore, hopefully, what is it? Where do you think we will see some probably respite coming in? We're all hearing of whatever you're going to see a lot of moves in terms of the RBI and the government trying to do their bit to kind of get flows into India. But so therefore, how are you viewing this period of grind for the Indian economy? Say for the next, say this FY27 is probably a year when we will go through this grind, and therefore from a market perspective and therefore from a portfolio strategy perspective, how will you incorporate it in your strategy?
Yeah, so I think and this is where these kind of markets when everything is up in the air is really when you need some bit of an anchoring. I think that's where our framework, like the Elevate framework that we use, helps us think in an anchored manner and then bring about a little bit of a science to this other side of market investment, which is an art. So I think if you were to just purely view it from that perspective and view it through the framework, what you actually see is growth is kind of holding up now. Some of it is because of probably front loading of demand, front loading of stock building that is happening, and therefore the March numbers need to be viewed with a little bit of a caution. I think we'll get to know the real signs of how India is getting impacted probably in the first quarter of this year, rather the current quarter, and that's probably when we'll get a better handle around where the earnings is going to be for the for the current fiscal year. I think that said, what one is actually seeing, some of this is anecdotal of course, is that demand is continuing to hold up reasonably well, and that seems to be the commentary that's emerging from corporate India as well for the quarter gone by. We need to keep a close watch on that and see are we picking up any signs of any change there or any concerns emerging over there. I think for its part, the government is doing various things, like for instance this credit guarantee scheme that they have put out to ensure that MSMEs don't get stressed on working capital and kind of they can tide over. Those are, I think, good measures. Of course, they are having to take some measures on the external account in terms of the curbs on gold imports, and now, of course, what they have done to the fuel price. These are necessary measures. We probably should have done some of these a little earlier and had to defer it for various reasons. But be that as it may, I think see that there is a cost that is coming, and the economy has to bear that cost. So the point is this cost going to result in demand destruction, or is it going to result in demand deferment? For now, given that we came into this crisis on a reasonably okay note, things were turning around at the micro level, and at the macro level things were looking okay. One does hope that this is more of a deferment
rather than a damage,
rather than a permanent damage. So the way to probably see it is FY27 earnings, I think, and from what one hears from the street estimates, it's a little all over the place, and
extremely divided, I must say.
Understandably, because we are going through a period of reasonable amount of uncertainty. So I think to look at FY27 and to draw conclusions from that may be a little myopic. one should probably look at the broader growth environment into FY28 and derive probably if there is any comfort from there. So the way to probably therefore view this from a portfolio strategy, how are we thinking about it, right? And so we are saying that this is a period which is a grinding period. You're going to see FY27 again be a very grinding kind of a period. But note one thing, under the surface there is a lot that's happening. So you are seeing huge amount of dispersion in sectoral movements in terms of different sectors and how they are behaving. We know what's happening, right? IT, realty on one side, capital markets, metals, energy on the other, autos. So there is a huge amount of dispersion. So active management is yet well positioned to deliver that alpha. And we have seen that also, right? So I think that is the starting point. First, we are saying that we be a little overweight on equities simply because, like I said earlier, we are just thinking that this is a deferment of demand rather than destruction. So therefore, that's number one. Number two is active over passives. Number three is, I think, and then this is a proprietary framework, right? How we think about equity portfolios. There is a cushion element, there is a cyclical element, and then there is a sector rotation element that is there. So I think that stands us in good stead in terms of trying to build that balance across an equity portfolio. And the last point I think here is about looking at ideas where portfolios are getting built. Because
while you're in that, so is that also a way, because when we spoke about this, we really didn't speak much about valuations and the risk, and I was just going to come on that. So is this point, how are you going to how are you viewing that then? Because there is active management where you're taking into account divergence in performance, in earnings. There are the three buckets that you're talking about, which will take care of the kind of phases in the economic cycle and the business cycle. But as far as valuations are concerned, how are you kind of building that into this piece?
See, I think valuations, I think insofar as Indian investors are concerned, because of the limited investment footprint that we have, we'll have to view it from the perspective of the earlier nomenclature or paradigm that we spoke about, which is basically saying that growth is picking up. If I can kind of look at a period slightly farther out,
FY28,
and if therefore valuations are looking okayish, I'd kind of consider building my portfolio gradually.
So the key word is building your portfolio gradually.
Building your portfolio gradually, and valuations are not actually very compelling. They're just about okay, right? Even from a historical perspective, they're just about okay. So you're just playing the Indian equity market opportunity because that's the limited footprint that you have. But bear in mind that's not the case with the global investors, and they're voting on their feet all through last year and this year, right? Because we all know what's the earnings valuations trade-off for India vis-a-vis a lot of the markets in the world. So that's a different story. We talk about right now, how do we as Indian investors navigate the environment right now. So there I think one of the elements is basically gradually build out a portfolio, get into strategies which have the luxury or the space to actually think ground up and say, in this kind of an environment, what kind of ideas can I populate in a portfolio? So therefore, not having too much of legacy there. So I think that's a benefit. So do a combination, look at some of these kind of ideas is what we are kind of saying, because this is a period where you will see businesses go through a tough time and earnings not showing up, and this could very well be a temporary phenomenon, and the markets could not look at it too well, and therefore this could present some interesting opportunities in those kind of spaces. So I think it's a mix of strategies around this is what we are actually saying insofar as equities are concerned. But at the same time, it's important that as Indian investors, we use the sliver of opportunity that we have to look at global investment ideas, because I think the rupee depreciation is a feature that we have experienced for the last 20-25 years. Roughly 3.5% per annum is par for the course. More than that, I think, is the fact that there are ideas in the world which we don't have over here.
So there are themes that could be relevant and India doesn't offer.
Yes. So therefore, it does make some sense to participate in them. I think we have been doing that, right? In our portfolio, we've been doing that. I think for quite some time, for quite a few years now. So I think that remains relevant. In that space, probably the emerging market space is looking slightly better than the developed market, particularly US, because there it appears like the entire growth is being predominantly led by AI, and that tends to kind of make you feel a little nervous. So I think that's really probably how one can kind of view this.
Sure. But lastly, coming back to the domestic piece, the way you pieced it out for us, saying that there's preference for active, there's this 3-bucket approach, build your portfolios gradually. So you talk about newly minted portfolios, for instance. Yeah. There's one cut which we have not spoken about, which is in terms of the very conventional large, mid, small. How would you kind of piece it up from that kind of, because small caps have had it very, very difficult in CY26. So is this therefore a time to kind of look at that segment of the market?
Yeah, so I think we are saying that this is a market which is going to go through its ups and downs in the next few months. It's not that we have seen peak pain behind us insofar as our economy is concerned. Okay. Probably we will continue to bumble around a little bit before we emerge out of the tunnel. So I think one should be prepared for that. So in such times, obviously you want to take comfort in the cushion of the large caps which are there, where valuations are not looking too stretched. They're looking pretty okay actually. So I think that's really therefore in a way a hiding place, if you can call it that. But at the same time, like we have seen a lot of small and mid caps, and it's very difficult to pass a very sweeping remark on that space, right? Because it's so heterogeneous. So to look at aggregates and pass a view probably doesn't do justice to the underlyings. So I think there a very banal approach of bottom up is what one will have to do. One will have to look at it very, very specific. And therefore take a view. But to your point on are we constructive there? Yes, of course we are constructive there. I think after the massacre of March and of course all through 2025, I think there are lots of pockets that we are seeing where things are kind of holding up well. It's again not that valuations have come off so much that they're looking so mouth-watering or very compelling. It is just that one expects that growth should be reasonably good, and therefore on a growth-adjusted valuation basis, you're kind of looking kind of okay.
So then therefore equity investors should not ideally expect October 20 to October 24 kind of returns. We are really not in that zone at all.
You still remember that? For a lot of us, I think that's distant history now.
But I think a lot of investors who've come in the last 2 years are so used to seeing those numbers of 25-30 odd percent. So I just thought it made sense to kind of talk about that. Okay, now this is largely as far as equities, and I think we've kind of spoken about that. There is this important part of the portfolio when we talk about asset allocation, which is fixed income.
Yes.
There's a global view as far as you said, US Fed more likely to hike rates. India probably, at least for those of us who heard what the governor had to say, I think he didn't indicate a rate hike. If anything, he said we're going to try and keep rates steady, we're going to keep liquidity easy. He sounded very, very comforting to, and bond markets cheered on that day. But that's now, I think, nearly 45 days, and yields have actually moved up substantially, almost across the curve. So how are you therefore viewing interest rates? Where do you see policy rates go from here? And I'm not going to talk about the 10-year yield. I'd rather take a view on fiscal deficit. And the other point is therefore from a debt strategy perspective, how would we kind of piece that together?
Yeah, so I think we started the year saying that rates would be lower for longer.
Lower for longer.
Yeah, I think that paradigm is very quietly being given the burial for understandable reasons right now. I think with whatever various estimates that economists make, it looks like inflation in FY27 is going to be north of 5. No,
but that's
north
still
of 5
within
is a very,
the 6% number. So
exactly.
It's still
So yeah. But then that means you don't have too much of a leeway from a real interest rate perspective, because your policy rate is at 5.25, 5.5, so therefore doesn't leave too much of a leeway. So it's going to be between a rock and a hard place for the RBI, clearly, there's no doubt about that. I think the best case situation is that they try and remain steady for some time. They clearly watch for signs of how core inflation is behaving.
And I think there we have some comfort, don't we?
There we have some comfort right now. That's where that other point that you made about El Niño.
Okay.
That comes to the fore. Of course, reservoir levels, good kharif crop, and all of that will tide us over for a good part of this year. But at the same time, if indeed this El Niño were to be as bad as it's already appearing to be, I mean, it's extremely humid in parts of the country. So if it is indeed so, then you probably will have to also project that food inflation is also going to start putting some pressure there. So I think if they were to start taking that into account, and then we don't know where crude is settling, right? If you recollect the RBI's projections, they have assumed crude to be at $85 to the barrel for FY27.
And one quarter, I think we'll be averaging 100.
Yes,
not
above 100.
Above 100.
And the rupee at 94. As we speak today, the rupee is at 95.
96.
96?
96 we ended. 96.14.
96, north of 96 actually. Yeah. So I think those are adjustments that will happen to the forecast. So I think it's going to be a little tough for the RBI to kind of handle this. I think therefore the money markets are already telling you that be prepared for a slightly difficult kind of a period. So our sense is therefore duration is a very tricky kind of a place to be now. It's really for the brave hearts. They will throw up opportunities, I'm sure, but those would probably be trading opportunities that the smart shooters can exploit. But for that, for investors, I think it presents reasonably good opportunities in the shorter end of the curve, right? Because yields are elevated. Just talking about how short-term yields have shot up by 40-50 basis points even in the last few weeks, I think. So getting 7 quarter-ish.
So you just buy and stay on hold for 1 year, 1.5 years. and
hold
you
to
get
maturity.
a good 7% kind of a...
Absolutely. So I think that's really what it is. The heartening thing about the accrual space is really on the credit, on the performing credit space. And from what I think we all are able to see, I think there the experience has been pretty heartening. I think corporate India, the balance sheets are, I think that's the major point.
Major point. Otherwise, typically when we talk about rates going up, the expectation is that probably that segment of the market will face the hit. But this time around, I think because our balance sheets are so good, this space is looking far better.
So I think that's a space that again seems to be offering a fair bit of promise. And something very adjacent to that is the real asset space, right? I mean, the last 1-2 years, real assets in India have really taken off.
So when you say real assets, you are referring to the REITs and InvITs and the related ecosystem funds that are investing in that?
Absolutely, yeah. So I think that's a space that continues to look very good. I know that there are certain concerns around this whole AI, IT-led concern around office space in India and so on and so forth. But zoom out a little bit, I think businesses tend to take a slightly longer-term perspective. So I think, and then given where office rentals are in India and the structural story that we have, I wouldn't be too worried. I think a lot of the REITs we see are grade A kind of REITs, high quality assets, largely customized for very large global companies. So I think carefully chosen assets, I think, continues to be a good space to look at. And of course, InvITs are quite attractive as well. With the whole monetization of all these utilities.
I think the counterparty risk over there typically is quite low. I think that's the big one over there.
Yeah. So I think that's a space that remains very attractive.
So if I were to draw up the fixed income portfolio, we're talking about short-term funds, buy and hold. So probably target maturity funds where your YTMs are looking quite good. We're talking about performing credit space. We're talking about real assets. And finally, to kind of complete this piece, we've talked about equities, we've talked about fixed income. Quickly, your take on gold. I know you made a reference to it in an earlier part of this conversation, but specifically for investors who are looking at building exposure to gold, it's been, something that they never expected. 10% up in a month, 15% down in a month is not what gold investors expect.
Yeah.
So then comes, is this continuing to be relevant in our portfolio, or should we start looking at it like another highly volatile asset class? How are you viewing this?
See, a lot of this is the here and now, and some of this is out into the future, is the way I kind of view it. See, the here and now changes very rapidly, and therefore it's the here and now, right? By definition. But therefore, 2 months ago, it all looked very uncertain. Therefore, gold was shining.
Yeah, 7,000. I thought the target was.
Suddenly now it's looking like a pariah, and because we're expecting Fed rates to go up, and therefore gold is not looking good, and so on and so forth. So, but now that's the here and now part of it. But zoom out into the future, in terms of the store of value that is there and for which gold tends to be viewed, I think that doesn't change too much. Well, one could say that very near term, last 1 month or so, some central banks have sold and stuff like that. I think it is for a rainy day, and they're using it as such. Gold is a rainy day asset, so therefore you use it. That way, I think it continues to play a small role. So I wouldn't, if one is looking at gold as a tactical asset class right now, that's really not the role it's going to play. It's going to disappoint you. You probably have to look at it as a really long-term store of value.
Probably some amount of stabilizer, I think, over a very long term kind of.
Yes. So I think that's really how it is. So I think, all in all, I think we are talking about a very well-rounded portfolio.
Exactly, yes.
Where we're saying that we are little overweight on equities and diversify the portfolio, but we choose active strategies over passives. Look at global equities. If you can, look at emerging markets over developed markets. Fixed income, we are saying stay short. Short as in short duration.
Short duration.
Short-term assets. Look at accrual assets. Therefore, there performing credit looks rock solid. Real assets, InvITs, REITs, and gold is the final part of the portfolio. I think that way, one were to build a portfolio, I think it brings up a fair bit of stability and plus offers you the potential for growth over a period of time.
Sure. So therefore, if I were to kind of, put it all together in one line, the way I'd probably describe it, I'd want you to correct me if I'm wrong, is that tumultuous times, but there are opportunities, and this is probably a good time to go and pick up those opportunities at the right price, gradually. Yes. Use this period to build your portfolio. Absolutely. Rather than taking those big binary bets. Absolutely. Just go slow, build your portfolio, and you should be good. Absolutely. Over a 3-5 year period. As
a last line, I'd probably leave this thought that, and someone put this beautifully. I don't recollect who, but he said that India is a market which disappoints both the optimists and the pessimists.
Oh my God.
The last 18 months, we have disappointed the optimists.
Okay.
Now probably the pessimists will get disappointed in the next 18 months. You never know. But,
so good.
But yeah.
Great. Thank you so much. I hope you found this useful. That's it from our end. Thank you so much.
Thank you.